Last week, the markets were mixed. Although many industries were in the red, we're actually starting to see investor sentiment shift in a more positive direction, moving closer to neutral. Just a week ago, it was sitting at extreme fear, so this is quite a notable change. You might also be forgiven for thinking the markets haven't performed well this year given the current negative sentiment, but the reality is very different. When we look at the S&P 500 as a whole, well, year to date is up 17%, and historically only once in the last 10 occasions of a president's first year has the market returned negative, and even then it was just 0.1%. So that does suggest we could close out the year very strong, and in fact since 1985 the S&P 500 has returned 11.8% annually. That is on average, and highlights a strong long-term trend. Now this week could have a huge impact on how the markets close out the year, as all eyes are on the Federal Reserve and a potential rate cut. In fact, they're set to announce their decision this Wednesday, with other countries following shortly, and we can see here the expectation is that we will get a rate cut. And experts we can see from JP Morgan, we're talking Morgan Stanley and Bank of America, each one does anticipate this cut is in fact coming. We can also see the expectation moving into 2026 is an additional 2 cuts, and even with the slight uptick that we've seen in inflation in the latest data, again a cut does look likely. Now we have to bear in mind this doesn't necessarily mean that the economy is back to full strength. We can see consumer borrowing costs remain high, and in fact consumer sentiment was near record lows just last month, although we can see from the latest data in December it has started to pick up, although very slightly. We've heard in fact throughout the year from companies that consumers are anxious, they're stressed, in fact they're buying less and trying to save more, and with that in mind, rate cut expected, we're looking at 7 stocks that are poised to benefit, and we'll kick things off with Microsoft. As always, we're going to highlight our own intrinsic price as well as the margin of safety on offer. Now Microsoft, remember, growth tech stocks in general benefit from lower discount rates because future cash flows are more valuable, and lower borrowing costs help them fund for expansions. Now they're up 9% in the last year. Year to date they're up 15%. So actually we've just seen they've slightly been underperforming the S&P, but actually over the last 10 years they're up 794%, massively outperforming, and they're on a pullback. We're talking around 15% from their all-time highs and 52-week high at $555, and we get a hold from Quant, a weaker buy rating from Seeking Alpha, but a very respectable and strong buy from Wall Street at 4.71 out of 5. Now they're also trading at a forward P of 28.8, which is below the 5-year average of 31.8, so straight away potentially undervalued, although we're not looking at this in isolation. It's also not at the lows that we saw during Liberation Day, that would be around the 27 mark, and if we look at the blue tunnel which highlights the intrinsic fair price, we can see it's right there towards the bottom end. That is another indication of potential undervaluation, although you'll see during Liberation Day the disparity was clearer, and that is how we can see undervaluation. Also, a quick side note, good to see the blue tunnel, the intrinsic price, increase over time. Not something we see with every single company. And zooming out to the last 10 years for Microsoft, well, just look at this stretch of period, long time where this company was trading solely at a premium, and very rarely do we see this company trade at any discount whatsoever. Now purely on a valuation grade, yes, they do get a D- given their forward P against the sector median does mean you're paying a 23% premium. As we've highlighted though, against their own 5-year average you're getting a discount, and for companies that have a faster growth rate than those maybe against the sector, we can focus on the PG, the price to earnings growth. Now they sit at 2.13. Reminder for investors, below 2 is really the sweet spot for serious consideration. Not far off, and against the sector at 1.7, you are paying a 24% premium, but Microsoft likely to be one of the best companies when we compare it to the sector median. So yes, they do deserve a premium. The question is always how much, and also against their own 5-year average, they're trading on a PG basis at an 11% discount. Now we did say for each one of these companies, we're going to give you our own intrinsic price, Microsoft $559 solely on the DCF. First things first, their 10-year CAGR shows they grew it at 13% year on year over the last 10. We've gone 16% around analyst expectations, in fact a little bit more conservative, where we have used their expectations for 2026. Now, what you might be drawn to is this here, the reverse DCF that tells us if you're buying when the market opens at around $482, baked in today is 13.6% growth moving forwards. Now, actually using that growth rate of 16%, where we have identified as the middle rate, gives double-digit upside. You actually want to be more conservative. Well, look, at 14%, 494, that's only 2% upside. If you believe we're being too conservative, well, at 18, 631, indicating 31. Now, as always, the numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, putting in your own numbers, Microsoft or any others, but we do want to be, as we typically are, using the middle rate to find out what is the margin of safety on offer, and that arrives at 14%. Now remember, we typically start off with 10% and we say, yes, we execute buy if it meets the 3 criteria, which you could argue Microsoft hits all of them. That is a wide moat, strong financial metrics, and good forward-looking data. Now look at Wall Street, they actually disagree. They see a lot more upside. They see the price at $630 into next year. That is 31%, so they are very bullish. In fact, a very high, strong buy rating. And if you agree with our assumptions, want to use some markers in terms of target prices, well, at 20%, a buy at 447 and 25 419. And what makes it really interesting, in fact, what Wall Street are essentially saying is they're anticipating 18% growth to the future free cash flows. That is how we get to $631, and that is exactly what they see over the next year. If you're in agreement with them or want to understand the margin of safety they see, well, it sits at 24%. But give us your views on Microsoft. Is this one maybe you're considering, whether you see it as a buy, perhaps a hold, or a complete avoid? Now, before we continue, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to realty income. Now essentially, REITs in general benefit from lower interest rates because borrowing for property is cheaper, yields become more attractive relative to bonds, and we can see they're up only 4% in the last year. Year to date, they're up 9%. Another one that's underperformed the S&P just in 2025. But if we zoom out to the last 10 years, well, unlike Microsoft, over the long term, it's actually underperformed. And we can see here it hasn't yet recovered the highs pre-COVID, February 2020 at $82, but it does currently trade at the upper end of the 52-week range. Also, side note, this company pays the dividend every single month, and we actually get, interestingly, a buy from Quant, 4 out of 5, very respectable buy from Seek Alpha, near the strong buy at 4.5, with Wall Street actually very rare occasion today to see them give a hold. Now they're trading at a P to AFFO, price to adjusted funds from operation, metric used for REITs in particular, 13.4, below the 5-year average of 15, another undervaluation signal, although this one did trade at the back end of 2023 at a P to FFO of 12, so not at a 5-year low, with the yield sitting now 5.5% above the 5-year at 5, although we can see here during that point where they were the cheapest valued, in fact the yield on offer was around 6.5%, and given they are a monthly dividend payer, we will just flag here the dividend does look to be safe with an 80 score, and you can also see the undervaluation signal. It does sit below the bottom end, something pretty continuous throughout the last 12 months. Also should flag the intrinsic value has started to come down slightly just in this period, where over the last 10 years, actually interesting to note, this one for most of it, in fact, going from around mid-2022 till around where we sit today, has been trading at a discount. Prior to that, though, we did, for the most part, see it in the reasonable signal. And valuation grade at a B-. Now, we do solely look at the P to AFFO here, which it trades at below 14. The sector sits at 15. So right now, Realty Income trading at around a 9% discount to the sector overall. And our intrinsic price gets to $67, the average of the three models that you can see on screen, and a margin of safety sitting around 13%. Now this one will be likely targeted for those that want to use the income, whether it's for reinvesting or for their own personal expenses, and a 13% MOS may be enough, it may not be. If you want to see 20, well, a buy at $53 and 25 around the $50 mark. Now, Wall Street, they were the only ones with the hold rating, see $63 into next year, 9% upside. Yes, it's not the largest upside, but with rate cuts, this could be one where we start to see it become a lot more attractive, as those who historically put money in high saving accounts, bonds, will see those rates drastically drop and therefore want to continue that level of income and move it into REITs, whether we're looking now at Realty Income. We also covered Vici Properties just a few days ago, so give us your views today. We then move on to the Kroger company, up 3% in the last year. Year to date, also not that great, underperformed the S&P. Over the last 10 years, again, we can see that. Just bear in mind though, when we talk about underperformance over the last 10 years, this is if you had bought 10 years ago today. For example, we can take a look here at the lowest point, 2019. If you bought then around $21, $22, you would be up around 3 times. Is also trading towards the lower end of the 52-week range. Triple buy rating from Seeking Alpha, Wall Street and Quant, although we do note they are all slightly below 4. Now this one's trading at a forward P of 12, pretty much in line with the 5-year average. You could argue the same for the yield. So on both accounts, it looks like Kroger could potentially be reasonably valued. And if we take a look at the blue tunnel, firstly, unlike Realty Income, we can see the fair price look to increase over the period. And actually, this one, more often than not, did trade at a premium. We're now seeing it move towards the lower end of the blue tunnel, where when we zoom out to the last 10 years, it actually has had quite a few times where it has traded severely undervalued, notably at the beginning of 2024, where it was trading below the $50 mark. Now, valuation at a C, forward P, where we do notice, in fact, a 19% discount to the sector, not too dissimilar from their own 5-year average, as we just covered. And remember, price to earnings growth isn't going to be applicable for every company, especially those that don't have continual fast growth rates. Sitting at 2 though, if you did want to know, that is a 23% discount to the sector, but actually a little bit higher, around 11% more than their own average at 1.81. Now our intrinsic price comes to $76, the average of the three. If you want to solely look at the DCF model, not too dissimilar in fact, 73.25. We've used a growth rate of 10% in line with analyst expectations. On a reverse DCF, lower slightly at 8.5. Will give you a good idea if you solely want to look at the DCF model, whether or not you believe these growth rates are reasonable and achievable. Now, using all three, you are looking at a 17% MOS. If you want 25, we'll buy at $57, and we can see Wall Street actually anticipate 79 into next year, 26% upside. So let us know with Kroger, maybe this is one that's on your radar. It has started to come down over the last few months, so it could be one of interest, or perhaps this industry as a whole, consumer staples, defensive companies, isn't for you. We then move on to Amazon, and as always with lower rates, it does mean cheaper capital for their growth and expansion, as well as consumer spending could get a slight boost if borrowing costs drop and disposable income rises. And over the last year, they're up only 4%. Year to date, again, up only 5%, massively underperformed the S&P. Although if you do zoom out to the last 10 years, they have outperformed, up 617%. On the pullback from all-time highs at $259, a strong buy from Wall Street, hold from Quant, very respectable, near strong buy from Seeking Alpha, where valuation at a D, if you look at a forward P, 33, 89% premium to the sector, massive discount to their own 5-year, but maybe more appropriate, the price to earnings growth, 1.8, that is below the 2, so that does get us excited, and also it's pretty much in line with the sector. And Amazon, as we said with other companies like Microsoft, will be one of, if not the highest quality in the sector bracket overall. Now our intrinsic price, $229 solely on the DCF. You can see the 10-year CAGR, they've been growing on average their free cash flow at 20%. We've gone conservative at 15. That's pretty much what is baked in today. So if you're adding 15% is the long-term expectation. So there is in fact no upside, and that also means no margin of safety, meaning for Amazon today, it looks like it's trading at a fair price. Wall Street in disagreement, they see $297 into next year. That is 30% upside. And if you want to use their average of the 20% level, well, we're talking $312, 36% upside. And that in turn comes to 27% margin of safety, although it is still slightly above Wall Street expectations. So we can, for example, play around with the numbers, put 19% in, and now we see this little bit below. So you could argue Wall Street themselves are expecting between 19 to 20% growth over the long term for Amazon, which indicates around 22-25% as an MOS. But give us your views. This one is causing a lot of frustration with investors because it hasn't done that well, at least in the shorter term. We then move on to Ultra Group. Now bear in mind, this yield that we're going to discuss will become more attractive when rate drops. Similar scenario as we've highlighted with other companies today, and it's up only 2% in the last year, 11% year to date. Over the last 10 years, pretty much flat around the 3% point, trading towards the lower end of the 52-week range. Double hold from Wall Street and Quant with a buy from Seek Alpha at 3.9 out of 5. And we also note the forward P at 10.5, not too dissimilar from the average at 9.6. The same to be said about the yield. This one in fact peaked around 10% as we can see at the back end of 2023, but both signals right now do look pretty much around a reasonable level, and we note here is trading right at the upper end of the blue tunnel. So yes, reasonable signal, but also we do notice for a vast period in the last 12 months it was trading at a premium. If rates continue to drop, this one could look more and more attractive, at least to those who do need the income or in fact want to reinvest. Valuation grade, we're getting an A-. In fact, against the sector, we see a 34% discount, little bit higher as we just point out to their own 5-year average. And whilst it isn't applicable for consistency, you can see here the PG coming at 3.3 at a double-digit premium to both sector and their 5-year average. Now, our intrinsic price gets to $62, pretty much where we do see it if you solely want to look at a DCF. Baked in today is negative 2% year on year over the longer term to their future free cash flow. We've been very conservative. The industry as a whole isn't one where we envision a lot of growth over the longer term. So using that minus 1%, you can see even cautiously we're getting an undervalued signal. And if we take a look holistically, you are looking at a 6% MOS. If you want 10%, well, a buy at 55, at 20 a buy at 49, and 25 $46. Wall Street themselves see 14% upside into next year, and in all honesty, if someone could guarantee that with the yield of over 7%, you probably would in fact be seriously considering. But do give us your views on Ultra Group, whether you're considering buying or perhaps the tobacco industry is just not one up for consideration. We then move on to the Coca-Cola company, up 11% in the last year, 12 year to date. Over the last 10, up around 66%. In fact, during the COVID drop, this one hit the lows of $38, so you'd be up nearly double if you did load the boat essentially at that point. And we can see it's trading at the upper end of the 52-week range. Double hold from Seek Alpha and Quant, very near a strong buy from Wall Street at 4.4 out of 5. And they're also trading at a forward P below 22. 5-year average 23.5, lowest back end of 2023 around the 19 point, and the yield not too dissimilar around the 3% point. Now the blue tunnel is highlighting we could see, if a little bit of a drop continues, undervaluation over this week or the next few weeks. But zooming out to the last 10 years, this is one of those rare companies that very, very rarely sees the light of day in an undervalued signal. We can see back end of 2023, but otherwise, in fact, incredibly rare to note. Now a D- in terms of the grading, and you probably would expect a company of Coca-Cola's quality and brand to be sitting at a premium, 46% to the sector, not too dissimilar from their 5-year average. And again, if you want to look at PG, not applicable, but 3.6, premium to the sector, double-digit discount to their historical. Now our intrinsic price gets to around the $70 mark. Actually, DCF coming in a lot lower at 59, where on a reverse basis, 12.5 is baked in. We've used 10%, and holistically, again, we can see this one is trading pretty much what we would say at its fair price. Now, if you believe this one deserves a 10% MOS, well, a buy at 62, at 20%, a buy at 56, and 25, $52. Wall Street, they are fairly bullish. They see $80 into next year. That is 14% upside. Give us your thoughts on Coca-Cola today, whether you see this as a buy or perhaps one to consider selling. We then move on to the Walt Disney Company, where lower rates can boost discretionary spending and make capital-intensive projects like parks, streaming content cheap to finance, as well as theme parks and media growth, which could benefit if consumer confidence rises due to lower rates. Now look, they're down 10% in the last year. Year to date, they're also down 5%. Over the last 10 years, they're actually down around 3%, meaning pretty much if you invested $5, $10, $20,000 10 years ago, you'd be sitting on that same amount today. We also note pretty much peaked around March 2021, just below $200, and currently trades around the midpoint of the 52-week range. We also get a hold from Quant, a weaker buy from Seek Alpha, a very near strong buy from Wall Street at 4.4 out of 5, and it's also trading at a forward P around the 16 mark, below the 5-year average of 21.3, yield 1.4%, much higher than the 5-year average at 0.9, and we also get a severe undervaluation signal, significant disparity between the trading price today and the bottom end. Nice to see as well, intrinsically, it has increased during this period. And zooming out to the last 10 years, well, this one has been on a bit of a roller coaster ride. Good to see though, more often than not, this one does trade at a discount, so if you are considering buying, this is something that perhaps will show up again. And valuation at a D+, pretty much trading in line with the sector. Massive disparity, so huge discount essentially against their 5-year average. And PEG, if you want to incorporate that, 1.46, not too dissimilar from their 5-year average, but actually around 28% cheaper than their historical 2. Now our intrinsic value gets to $137 solely on the DCF, which as always you can grab a copy by clicking below. 10-year CAGR is in fact 2%, baked in today is 4.8. Now we've used 8% moving forwards, which is pretty much in line with where Wall Street see this in terms of the output, $138. We see here $137, and that translates to a 23% margin of safety. You could argue that is one where you would consider, whether that's for Walt Disney Company or any others. We can also point out here at a 30% a buy at 96. We'll also point out, for example, for those that want to be more conservative at the 6%, you're still looking at a margin of safety, naturally less attractive. It is lower at 10%. But Wall Street, very, very confident, as we saw the near strong buy rating. They have this 31% upside into next year, $138 price target. So let us know for Walt Disney as well as the other companies whether you believe these are ones for serious consideration as we move into an environment where rate cuts do look very likely, as well as a projected to into 2026. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.